Everyone wants to build wealth, but very few people stop to ask a more important question. Not how to make money, but how to keep it. Because earning money is one challenge. Keeping it is another, and keeping it across generations is something entirely different. History shows a fascinating pattern when it comes to wealth. Studies have found that around 70% of wealthy families lose their wealth by the second generation, and nearly 90% lose it by the third. Think about that for a moment. A lifetime of hard work, years of sacrifice, decades spent building financial security, often disappears within just a few decades. So why does this happen? Why do so many fortunes vanish after the original wealth creator is gone? Different cultures have noticed this pattern for centuries. In the United States, people often say, shirt sleeves to shirt sleeves in 3 generations. The first generation builds the wealth through hard work. The second generation grows up comfortable. And the third generation often loses everything. But here's the interesting part. Some families completely break this pattern. Their wealth lasts for generations, sometimes even centuries. Their financial stability survives recessions, market crashes, and leadership changes within the family. So what makes the difference? It isn't luck, and it isn't just about having more money. The real difference comes from a set of principles that guide how wealth is built, managed, and passed down. Today we're going to explore 5 powerful keys to long-term family wealth. These are the habits and systems that help families protect their financial future, not just for themselves, but for their children and grandchildren as well. Let's begin with the first key. Key has ownership over income. Most people spend their lives focusing on income. A better job, a higher salary, more overtime, another promotion. And while increasing income is certainly helpful, wealthy families understand something deeper. Income alone rarely creates lasting wealth. Ownership does. Income stops when work stops. Ownership continues producing value. This is why families that maintain wealth often prioritize owning assets rather than simply earning wages. Assets represent ownership in something productive. And productive assets have the ability to generate income over time. Examples of these assets include stocks, real estate, businesses, private investments, intellectual property. When you own stock, you own a small piece of a company. As that company grows and becomes more profitable, the value of your ownership can grow as well. Real estate can generate rental income while the property itself appreciates in value. Owning a business allows profits to continue flowing even after the company has been established. Each of these assets creates something powerful. Income that doesn't depend directly on your time. Instead of trading hours for dollars forever, assets begin working on your behalf. And over time, that work compounds. Wealthy families often follow a simple pattern. They convert earned income into ownership, then they allow those assets to grow over long periods. Eventually, the income produced by assets can exceed the income produced by labor. At that point, the family's financial momentum becomes self-sustaining. And when those assets are passed down to the next generation, the starting point for that generation is much stronger than the previous one. Ownership creates the foundation for generational wealth. Key #2. Financial education for the next generation. One of the most common reasons wealth disappears is surprisingly simple. The next generation doesn't understand how to manage it. Imagine someone inheriting millions of dollars without understanding investing, budgeting, taxes, or financial risk. Without the knowledge to manage wealth responsibly, money can disappear quickly. Spending habits may spiral out of control. Bad investment opportunities may seem attractive. Friends, advisors, or business partners might take advantage of inexperience. Wealthy families understand this risk. That's why many of them place a strong emphasis on financial education. Children are introduced to financial concepts at a young age. Money becomes a normal topic of conversation. They learn how savings grow over time. They learn how investing works. They learn the difference between assets and liabilities. Some families even encourage children to manage small investment portfolios. This gives them real-world experience before they ever inherit significant wealth. Other families involve teenagers in conversations about family businesses or investment strategies. The goal isn't just to pass down money. The goal is to pass down knowledge and responsibility. Because money without financial education is fragile, but money combined with financial wisdom can last for generations. Key #3, long-term thinking. One of the biggest differences between wealthy families and average investors is time horizon. Most people make financial decisions based on the short term. They focus on the next month, the next year, maybe the next 5 years. But families that maintain wealth often think much further ahead. They think in decades, sometimes even generations. Instead of asking, what investment will perform best this year? They ask, what assets will still be valuable 20 or 30 years from now? This long-term mindset changes how decisions are made. Short-term market fluctuations become less important. Long-term growth becomes the priority. Wealthy families often hold investments for decades instead of constantly buying and selling. This patience allows compounding to work its magic. Compounding is one of the most powerful forces in finance. When investments grow year after year, the returns themselves begin generating additional returns. Over long periods, this growth can become exponential. A single investment held for 30 years can sometimes outperform dozens of short-term trades. Patience becomes a strategic advantage. And when families think beyond their own lifetimes, their financial decisions become much more powerful. Key #4, protecting wealth with structure. Building wealth is only half the battle. Protecting it is equally important. Without protection, wealth can disappear through taxes, lawsuits, poor planning, or unexpected events. This is why many wealthy families create legal and financial structures designed to protect their assets. These structures might include trusts, estate plans, family holding companies, insurance strategies. Trusts are particularly common in families with significant wealth. They allow assets to be managed and distributed according to specific rules. Instead of giving a large inheritance directly to heirs, a trust can distribute money gradually. This helps ensure that wealth is used responsibly. Estate planning is another important tool. Without proper planning, large portions of wealth can be lost during the transfer between generations. Taxes, legal complications, and disputes can all reduce the value of an inheritance. Wealthy families plan ahead to minimize these risks. These structures act like protective armor around the family's finances. They ensure that wealth survives not just during good times, but also during unexpected challenges. Key #5, building a culture of stewardship. The final key to long-term family wealth may be the most important of all. And it isn't financial, it's cultural. Families that maintain wealth across generations often develop a shared philosophy about money. They view wealth not simply as something to spend, but something to protect and grow. Each generation sees itself as a steward of the family legacy. That mindset changes behavior. Instead of asking, how can I spend this money? The question becomes, how can I grow this wealth for the next generation? This sense of responsibility encourages discipline. It encourages long-term thinking, and it encourages cooperation among family members. Some wealthy families hold regular family meetings to discuss financial goals and investments. Others create written family mission statements that outline values related to money, responsibility, and legacy. These traditions reinforce the idea that wealth is part of a larger story. A story built through hard work, sacrifice, and careful decision-making. When this mindset becomes part of family culture, wealth is much more likely to survive across generations. Because culture influences behavior, and behavior determines financial outcomes. The big lesson: when you study families that maintain wealth for generations, a clear pattern appears. It isn't just about how much money they start with. It's about the system surrounding that money. Ownership instead of just income, financial education for future generations, long-term thinking, legal structures that protect assets, and a culture that values stewardship and responsibility. When these elements work together, wealth becomes incredibly resilient. It can survive market downturns. It can survive leadership changes within the family. And it can survive the passage of time. But without these principles, even large fortunes can disappear surprisingly quickly. Money alone doesn't create generational wealth. Systems do. Mindsets do. Structures do. And families that understand this build something far more valuable than money. They build stability, opportunity, security, not just for themselves, but for generations to come